All right, guys. Thank you. Um, I'm going to talk a little bit more about tax returns today. I'm going to talk a little bit more about um, what differentiates us from the competition. And then we're going to do a lot of case. We're going to do a lot more case studies later on. But I just wanted to kind of build some credibility for you guys and some fundamental sort of evaluations of tax returns that we have found incredibly helpful when talking with clients. So before I go into the tax returns, I wanted just to remind you, certainly with everything going on in this crazy environment we're in, a lot of people out there have a lot of anxiety, and they are nervous and anxious. And I think the vast majority of this reason is because of this control issue, right? A lot of people feel like they don't have any control. And historically speaking, when different types of financial people kind of go over people's financial plans and portfolios or whatever it is, the vast majority of what people talk about is performance. What's your rate of return? Let's project the rate of return forward. And interestingly enough, performance is one of those things that we get wrong 100% of the time. So let's think about that for a second. The traditional plan says, let's project forward what you're going to have, but 100% time we're going to be wrong. So that's not a great feeling, right? And then, of course, you have the added element of, oh my gosh, I don't actually have any control over this. So maybe my retirement is based upon a performance number and a certain amount of interest or income or whatever it is, and the numbers are constantly changing. So how do I know if I can retire? So people have a lot of this sort of out of control feeling, and I get it too, guys. I'm not different than anybody else out there, right? The market goes down, I'm like, oh. I get this sinking feeling in the pit of my stomach because it makes me anxious, not for myself or for my personal clients, because most of our clients are in safe, principally protected things, but for the general economy out there, it's just a horrible feeling, and we sometimes shoulder the burden of all that anxiety and uncertainty. So we try to really focus on the things that we can control, and this is one of those things, and this is going to be our mantra. And I say this all the time. I say this word for word in client meetings as well as in the training. But I want you guys to just think about this, right? Nobody out there can promise that anybody's going to be able to make any more money. In fact, if there was any one investment out there that made more money than everybody else, we would all be in it. But there's a reason why there's like 2,000 different investment companies out there, and each one of them have like 200 different offerings, right? There's a reason for that. Nobody can promise anybody can make more money. However, we can promise our clients that they can keep more of the money they make. Excuse me. And that's what really hits home with people. That's something that they can relate to. You can't guarantee more profit, but through reduction of taxes, through reduction of fees, and through lessening volatility, we can certainly guarantee you're going to keep more of the money you make. All right? So control what we can control. And I've heard people say this before, and I've even said in the webinars, 80% of the things that people worry about and have anxiety about and are anxious about never happens. 80% of the things that cause us stress never comes to fruition. So we're spending an awful lot of time stressing and worrying about stuff that really doesn't actually end up being relevant to us. So what can we control, and how do we impress upon our clients so we can control those things? Well, today we're going to be talking about taxes, and we're going to be focusing in on how to read the returns and how to build credibility off those returns. And then after we do that, we'll talk more about fees and volatility, sequence of returns, all the really exciting things that people don't realize when you start quantifying lost opportunity, cost of fees, and things like that. That's great stuff. But we have to have a fundamental, basic understanding of taxes. So when we tell this story about building credibility for tax return, and I tell people this all the time, I'm not a tax advisor, and my joke is I get it. I'm an Asian dude, I wear glasses, obviously I'm good at math, but I'm not a tax guy. People are going to assume that I'm a tax guy because I'm talking about taxes, right? We're going to talk about tax strategy. We're going to explain to them how taxes work. This hasn't been done before. And it's mind-boggling to me that other people who have dealt with your client's finances haven't gone through the discussion about how taxes work, identify where your marginal tax bracket is now, look at where it's going to be in the future, and build a plan to save money on taxes. right? The CPAs aren't doing it. The enrolled agents aren't doing it. The tax preparers aren't doing it. Well, who the heck is doing it, right? Well, very, very few people are doing it. And you guys can probably relate with your clients. When was the last time you saw somebody that came into your office with a bona fide tax strategy? Here's what I'm doing. I'm tax harvesting for the next 10 years. Then I'm going to start Roth converting between 2021 and 2025. And then my exit strategy is to establish a charitable trust to create deductions so that I pay less tax overall. Right? You don't see that happening, but it's so simple. Right? It's so simple because there aren't too many people out there that don't want to save money on taxes. So building credibility for tax return, I'm going to pull up a couple of tax returns right now. We're going to go through them, but before I do that, I also want you to see some really good resources. So I have pulled up online the tax tables. And by the way, my tax tables are horrible, right? On my calculators, they're not even updated and they're not super comprehensive. I use them as a reference tool for clients to teach them, but this is a 2020 reference guide that you can use. If you guys don't have it, all you have to literally do is what I did is I Googled 2020 tax reference guide, and 15 different companies pulled up really great reference guides. This one is the one from TIAA-CREF. Okay, so you can photocopy portions of this and hand them out during your workshops. That's what I do, or email them during webinars, or just have them on the screen like I have it. But we start off with the taxable marginal rates here, and I'm going to go over how to calculate marginal rate in a second. Okay, but then they also have all the different married statuses that you can have: single, married, head of household. It's got the standard deductions here, right? These are consumer price indexed standard deductions, so they're going up a little bit each year. It's got personal exemptions suspended until 2025, so that's all really good information. Personal exemptions, I think, were about $4,350 a person. So those are gone because standard deductions are now much, much greater. Then we have long-term capital gains rates. This is an area where a lot of people don't know, right? 0, 15, and 20% max. And we'll talk about these capital gains rates also in relation to appreciated assets when we talk about charitable trusts. Gosh, I love this. Look at the Medicare surtax. Right? Modified adjusted gross income. Hopefully you guys know what modified adjusted gross income is. If you don't, in fact, let's just look at it right now because I've done this before. Modified adjusted gross income. This is a little bit of an education process for your clients, right? Modified adjusted gross income. Got to know what it is, right? So let's see here. How modified adjusted gross income works. You figure your income, your gross income, and you get your AGI, and then you got to add back certain amounts to find your modified adjusted gross income, including alimony, business income, capital gains, dividends, royals, rentals, retirement income, tips, wages, so on and so forth. So modified adjusted gross income is not your adjusted gross income, and it's also not your taxable income. So this is really, really good information, like I said, that people should be able to find out. You will also see on here some Social Security information, which is incredible, right? It shows you the wage base for maximum amount of income that you need to contribute to Social Security. It shows you the retirement incomes that you can earn before you get penalized under full retirement age. It shows you, your full retirement age number. And how much income you can earn on additional income other than Social Security, and how much tax you'd have to pay on Social Security. So a lot of people don't realize this, but if you take your Social Security income that you're getting plus whatever your other provisional income is, that's how you get the total income to figure out this number. All right, so I'm not going to spend a ton of time on Social Security today, but I wanted you guys to see this. And of course, it's got the Social Security maximum ages, or full retirement age, I should say, for different dates of birth, which is amazing. Estate taxes, right here. Of course, this was the Tax Cut Jobs Act of 2017. They created not only a larger estate tax exemption, but gave these things COLA adjustments as well. So these things are going up. But remember, these all sunset, right? All these changes are going to sunset in 2025. So moving forward, I think it's one of those who knows, right? So, there's all this extra information. I would definitely encourage you guys to familiarize yourself with all these different tax situations and guides and everything else. Let's just go right to married filing jointly, and this is the example that I use all the time, right? Let's say you're married filing jointly and you make $100,000 a year. Okay. Because you're in a 22% bracket, that doesn't mean you pay 22% of 100,000. It doesn't mean you pay $22,000 in taxes, right? What it basically means is here's your base tax. You see what says tax plus? So your base tax in the 22% bracket is $9,000. Then you pay 22% on anything above 80, right? So if we're making 100, that's $20,000 above 80. That's $4,400 roughly of taxes on the 22% bracket. So I'll add 4,400 to 19, and I'll get like $13,600. So you pay $13,600 in taxes on $100,000 of income. So your effective or average tax rate is 13%, but your marginal tax rate is 22%. I'm telling you right now, that's a simple explanation, right? It's not too complicated. People don't know this, right? They've never really done it. So just by you going through this very simple exercise with them, showing them how it works, will create a ton of credibility for you and put you in a position where they really see you as a tax guy. All right. Capital gains tax. A lot of people don't also realize this. If you are in a 0% tax rate on a married filing joint, you can make up to $80,000. So let's say, for example, you make your income, your taxable income is $50,000. You can sell $30,000 worth of gain on a stock portfolio, a mutual fund portfolio, or you can sell a house with some gain and pay zero tax. Right? So that opportunity, by the way, passes people by all the time, and it is an absolute travesty. Right? We see it all the time. So we want to let people be aware of this capital gain situation so they can capitalize on their tax rates, because very, very seldom do they actually do it. All right? And the maximum, you can have $5 million worth of capital gain, guys, and you only pay 20% tax. That's the cap. So it doesn't make any difference if you make $500,000 or $5 million of a capital gain. It's a 20% tax. That's actually a pretty nice opportunity for us to get people to sell real estate, cash out of investments, other things like that, realize gains, and pay taxes. Of course, and you guys should probably be generally aware of this, anything that is subject to capital gains tax can be donated to a charitable trust. And if you donate that instrument or property, whatever it is, into a charitable trust, and you can sell it inside the trust, you avoid that capital gains tax event. So there's exit strategies that we'll be talking to our clients about, but this has been an incredible resource for the explanation for me at workshops and webinars now, of course, on how to figure out taxes. So the second part of this is you want your clients to be able to project out how much tax they're going to be paying in retirement, right? So if you say to them, well, they're going to be making, let's say they're going to be making $90,000 in retirement, that's great and all, but we need to subtract out, how much money they're actually going to have, so we can show them what bracket they're in, how much tax they're going to pay, and they usually really appreciate that. Okay. Of course, our calculators show the tax brackets as well, right? So we can do the same calculations on the different filing statuses, and but my calculator is a little bit older. The ones online are updated. Mine haven't really looked into updating too much because I can extrapolate, but going through this exercise with people is very, very helpful. So let me go ahead and pull up a couple tax returns, and we'll just talk a little bit about how to read them, and then we're going to talk more about Roth conversions also, and we'll talk a little bit about some exit strategies. But let's go ahead and see if I can pull up a couple tax returns. So these are actual, obviously, real live client tax returns that I've accumulated, and they tell us a lot of information. And I just wanted you to get comfortable with reading the tax returns. So in this particular case, there's some pretty good information here on this return. I can tell the person's still working, and this is sort of like, I sort of equate reading the tax returns to playing poker and reading a hand blind, right? I can kind of see what somebody has on the table, and I can tell what they have in their hand. And it's a kind of a cool thing because, again, it's total credibility for you guys, right? You don't have to be the guru of all gurus to learn how to read tax returns, but it does make you seem very, very credible. So I know the guy's still working, husband and wife. I can see the yourself and your spouse checked off, right? So they're earning some wages. They got a little bit of interest, not a lot. So this is probably just some money in the bank or CDs or whatever. But there is a lot of qualified dividends and tax-exempt interest. So when I see qualified dividends and tax-exempt interest, I hear one thing and one thing only, right? I hear mutual funds. And I know this guy has mutual funds because usually mutual funds will throw off a combination of dividends and capital gains, right? And by the way, you do not have to be making a profit in your mutual funds. And I'll tell people this. You do not have to be making a profit in your mutual funds to be spinning off dividends and capital gains. You can actually have a value that's lower. So your account could have gone from $800,000 to $600,000. You could have lost 20% of the value of your account, and it could still spin off dividends and capital gains, and you can still pay taxes on it. Why? Because you don't control when the underlying money manager in your fund buys or sells anything, right? So they literally could have sold something at a gain and then had the value of the rest of your account go down because of the market. You still have to pay tax on whatever they sold as a gain, right? And or similarly, the market goes down, right? And there's a sell-off because they want to move their positions out of the market to keep you safer, to reduce volatility, and that generates capital gains because it's been a deferred account where these things have been growing and having profit in previous years, even though, again, same thing, you've lost money in the balance of your account, you pay taxes. People don't understand and realize that that's even possible. The other thing that I'd like to ask people, and this is kind of a really neat buzz, not a buzzword, but a buzz term or buzz question. Mr. and Mrs. Client, I see here that you are actually kind of generating about $75,000 almost of dividends and capital gains from your mutual fund portfolio. What are you doing with that $70,000 bucks? And normally the answer is, oh, well, we're reinvesting that money. And I said, well, so let me just make sure I understand what you're saying. You're earning interest, dividends, capital gains. You're paying taxes on these earnings. So you're paying taxes on them right now, and you're reinvesting that money just so you can pay taxes on it again. And you hear those crickets? I just let it be silent because I want that strategy to sink in. I want them to think about, well, why on earth would I ever do that? Right? And I'm going to just jump to the calculator for a second. I'm going to show you the number here. This is one of the strategies that we call flat taxing. It's a pretty easy thing to explain to people, but let's just use this mutual fund example, right? Let's say somebody's got $500,000 bucks, and let's say that let's just do this for 20 years, and let's say their tax rate after state and federal is 30%. Okay, so as their money grows, your $500,000 grows and earns just a reasonable, modest interest rate. Your $500,000 over time should easily grow to $1.3 million, right? But it's not growing that way just because of the taxes at this point, right? I'm not going to talk about fees, just taxes right now. I'm going to show people these are the taxes that you're taking out of your account each year, right? So at the end of that period of time, you've paid $247,000 in taxes based upon this scenario of inefficiency that I'm looking at right here on your tax return. Where's my tax return? I don't know where it is now. Here it is, right? Just because of all this, you have some taxes you're paying. In fact, this is actually worse than I'm illustrating. The tax here is way, way worse. But in any case, you'll pay $250,000 in taxes over that 20-year period of time. What if we were to take out your gain every year or move some of this money and tax shelter it so that it's not, well, that's not the right number, so it's not taxable again. Maybe it's $22,000. Trying to figure it out. Yeah, pretty close, right? So watch what happens if I don't allow my investment to compound. So at the end of that 20-year period, I still have 500 and something thousand. I'm taking out a lot of my gain in interest. Look at what happens to my tax. My tax flattens out. So I've saved $100,000 in taxes by flattening this tax, right? And I've now moved $22,000 a year into something that's tax-free. Do you guys have any ideas where you might be able to put $22,000 a year of somebody's money into somewhere where it's tax-free? And by the way, those solutions also enable us to lessen volatility. So at the end of your life, instead of having $1.3 million in something that's completely taxable, you now have 500 and something in something that's completely taxable. You saved $100,000 in taxes, but now we have another $600,000 or $700,000 in something tax-free, like a Roth, like a insurance policy, like any other types of trusts or tax shelters that we want to do for these guys, right? So that's a pretty simple strategy, and it only takes a couple seconds to explain to people how they work. All right. So this is a decent example of a very, very inefficient and obviously lack of tax strategy here for this particular client. So let me go ahead and pull up. Let's see if I know how to do this. Go back and back Google Drive. Maybe this one here. Okay. So I don't know where I went in here. I got to go back to the taxes. I shouldn't be allowed to look at this stuff. Do this by myself. All right, well, I'm going to pull up a couple other tax scenarios and see if I can, maybe it's in here. Yep, here we go. So I accidentally closed it out, but I've got more tax returns. Here's another one. Yep. So I try to pull out some tax return examples that have a little bit of interesting things going on here. Again, I know this person is still working, husband and wife, married filing jointly, but there's a big pension coming in here. This 15B could be a pension or an annuity, or it could also be an IRA distribution. It could be an RMD. Okay, so what this is telling me is, in fact, 16B. So this person has a pension coming in, but they also have an RMD. So this is telling me that the guy's got a massive chunk of money in qualified retirement accounts, right? Because they're taking money out each year, and it's all going into this taxable column. This person's probably a little bit older. How do I know they're older? When I say older, I'm talking about, gosh, maybe early 70s. And the reason why I know that they're early 70s is because they've really maxed out Social Security here. I see these Social Security benefits that they've maxed out, and if my hunch is correct, and this is an RMD, they don't need the money. They don't need the money because they're still earning wages, but they're over 70, so they're forced to take the money out, right? They're drawing pensions. They're getting their RMDs. They're still earning wages. They're earning Social Security. What I can tell you about this guy right here is they do not like taxes. These guys are going to get crushed on taxes. Everything's taxable, right? And I think I can see there's still some self-employment going on here. But man, when I look at this, I'm thinking, holy cow, that's a lot of income. And it's not a great thing for them. Of course, you'll see a lot of a lot of itemized deductions here. People have high income. They probably have a lot of, obviously, state income tax they're paying as a deduction. They might have other deductions on real estate mortgages. They might have other deductions on other things. In fact, I might have this person's itemized deductions. But this is way more than the standard deduction, which means that any other tax strategies that we find for these guys will be able to be utilized, right? Sometimes we find tax deductions for people, but they're not able to utilize them because the standard deduction is all they take. So it's a little bit wasted. But this guy, there won't be any tax benefits wasted because they're getting crushed. Let me see if I can find, yeah, here we go. So taxes, interest, and gifts. Oh, look at that, gifts to charity, right? What a great candidate for a charitable trust. I mean, I can just tell by the return. They want to save money on taxes. They love charities. There's going to be a tremendous fit for these guys for charitable trusts. So those are just a couple of quick examples that I wanted to show you guys. We'll spend a lot more time on this. The credibility of a tax return, we'll go back and forth and do some case studies and some other calculators and kind of show you how we use these all at point of sale. Thank you guys very much. I know that was a quick half hour. Hope you guys are doing great. Please reach out to us. I'm going to brag about my staff for 10 seconds here. We just did a webinar yesterday for a brand new group of people that are not in our existing client database. We had 1,200 people register for our webinar, and our webinar capacity is 1,001. So as I'm watching people sign on, we had 998 people actually show up for this webinar. and 540 of them reached out to us immediately, filled out the survey, and requested meetings. And so, that was, just sort of the process that we've been using in our office to really get in front of new prospects and to stay ahead of this curve of the webinar technology, meeting clients, being a resource for them, using our nonprofit. It's really been a tremendous, tremendous thing for us. So if you're not really up to date with what's going on marketing-wise and how the adaptation in our business has been, how we've been able to achieve that, please, reach out to us and try to engage our program and let us know if you need any help. And we'll catch you guys all again next week. Thank you, guys. Have a great week. Bye.